Hey everybody, so in this video, I wanted to talk about the Fed's funds rate, the economic projections materials, and I wanted to talk about just how the S&P 500 reacted. So let's go ahead and let's look at September of 2016. So this is September 21st of 2016. So the interest rates at this time, the Fed's funds rate, this was at 0.5%. So what did the summary of economic projections say, or the projections materials right here? So it said right here that the Fed's funds rate, they wanted to take this to about zero point 0.6 in 2016. This was the median. Now in 2017, they wanted to take this to 1.1. Now in 2018, they wanted to take this to 1.9. 2019, 2.6. Now pay attention to the prior meetings projections. So the prior meetings projections, they wanted to take this much higher. So they wanted to take it to 0.9 at the end of 2016. They also wanted to take it to 1.6% in 2017 and 2.4% in 2018. So, this was actually pretty bearish here in June, but this September projections material from 2016, this was very, very positive. I mean, look at the difference. So it's actually revising downwards. So let's just go ahead and look at SPY. So let's go back to 2016 of September. So that's right around this range right here. So it didn't really react too much at all. So as a matter of fact, it really didn't react at all. It really just went up a little bit more. So this entire period from 2016 of January all the way up here to 2018, it's just been going up nonstop. So let's go ahead and let's look at the next summary of projections materials. Now, this one is in December of 2016. So if we're going back here and we're looking at December of 2016, we got a 0.25 rate hike. So we went to 0.75. So let's go ahead and let's look at that summary of projections. So right here, if we're looking at the Fed's funds rate summary of projections for 2016, it says right here 0.6, 1.4, 2.1, 2.9. So this actually got revised upwards, as you guys can see. So in the September's projections material, they were saying 1.1 for 2017, but here in the December one, they revised that upwards to 1.4. Now in 2018, they revised that up as well to 2.1. In 2019, they went from 2.6 to 2.9. So it got revised upwards. So this should have been a little bit more bearish. But let's see how SPY reacted in 2016 of December. So let's just go right here. And if we're just looking, it had a Santa Claus rally. It just rallied even more. So, let's go all the way here to December of 2017. So what happened then? So let's go all the way over to December of 2017. So if we're looking right here, interest rates went up to 1.5%. So keep in mind, in 2016, this was 0.75, so it basically doubled. So in December 13th of 2017, we went up to 1.5%. So what did the Fed economic projections say? So here, let's see. It said, okay, Fed's funds rate is 1.4 for 2017. Now, 2018, they want to add 2.1. 2019, they want to add 2.7. 2020, they want to add 3.1. So if we're looking at the September's projections materials for 2017, it didn't really change all that much except for this 2020 projection. They revised it slightly upwards. So other than that, not a whole lot changed. So let's look at December of 2017 on SPY. So let's see, where is that? It's right around here. So yeah, December of 2017 on SPY, we basically had another Santa Claus rally. But this time, here in the new year of 2018, near the end of January, we had this seasonality dump right here, and we chopped around a little bit sideways. And let's go ahead and look at another Fed summary projections. So this time we're looking at December 19th of 2018. So let's go ahead and look at these rates right here. So December 19th of 2018. All right, so where is that? It's right here. So we went to 2.5%. Keep in mind, in 2017, this was basically 1.5%. So we went up, let's see, we went up pretty much 1%. So December 19th, 2018, Fed's funds rate was 2.5%. So let's go ahead and let's read this projections materials. So right here, 2018 says 2.4%. 2019, it says 2.9%. 2020, it says 3.1%. 2021, it says 3.1%. So this was actually pretty bullish because look, it got revised downwards. So right here, we can see, they're expecting 3.1% from the September projections, but now it's saying 2.9. It was expecting 3.4 in 2020, now it's saying 3.1. It was also expecting 3.4 in 2021, now it's saying 3.1. And in the longer run, they want to take it to 2.8 instead of 3. So this was actually pretty bullish. So if we're looking back here in SPY, obviously those interest rate hikes took its toll because you can see that we started selling off pretty hard here. And then all the way down here, this is where we bottomed. So we bottomed basically when the interest rates paused at 2.5%. So look right here, December 19th, 2018. It went up to 2.5% and then it paused. So that's December, January, March, May, June, and then look, here in July, they pivoted. So they did a complete pivot here in July. And then this is when they started cutting rates. So it went from 2.5 to 0.25 less. And then another 0.25 less. Another 0.25 less. So right here, it kind of went aggressively. So it went from the July meeting, they cut. And then in the September meeting, they cut. And in the October meeting, they cut. So let's go over to SPY. So in 2018, it essentially bottomed when the interest rates topped out and then they held it there. So that is essentially when the market said, oh, okay, well, we think that the Fed is bluffing and, now we're going to have this huge rally. And it happened to happen right around the 200 weekly. So each candlestick right here is representing 1 week. So, at that very last interest rate hike before they paused, the stock market basically just rallied. So it rallied right here for quite a bit. And you can see, it's going all the way into 2019. And then, this is going all the way into 2020. So it essentially just continuously rallied until we had the COVID crash. So, what can we learn from this? Well, essentially what history has told me from this is that when the Fed decides to pause the rates, that seems like when the market decides to turn around. So I'm not saying that history is going to repeat itself, but I'm just saying this is what happened last time in the 2018 crash. And this is when we bottomed out, when the interest rates finally decided to hold at a certain level. So just to reiterate my point, back in December of 2018, which is right here, we hit 2.5%. We held it there for basically 2 quarters. But then the S&P 500, it rallied when we started holding the rates. So hope you guys enjoyed this video. Hope you found it helpful and have a good one.